Hello, everyone. My name is Nikhil Reddy, and I will be presenting the risks of the market and how investing can work against you. So, in recent presentations, we've talked more about how the stock market can actually benefit you, and it can, but we haven't really gone into the risks of the market and how the stock market actually can be a pretty risky place for your money. So, let's get straight into it. We're going to present three different examples of the stock market actually falling. And you've probably heard about most of these: the 2008 financial crisis, COVID-19 crash, and the GameStop AMC debacle. Okay. Most of you have probably heard about all three of these, but we're going to go a little bit more in depth into them and how it's risky for how each of them represent a risk for your money. Okay. And I like this picture right here. Is actually a picture from the Great Depression. He is trying to sell his car for $100 because he lost probably most of it in the stock market. It's an interesting picture for an interesting time. Let's get straight into it. The 2008 financial crisis. And I put this as being skeptical because if more people were skeptical at that time, they probably wouldn't have lost as much money. And something to keep in mind. The 2008 financial crisis is one of the top 5 worst financial crises in US history. In short, because there's a movie on this exact thing. The 2008 financial crisis was brought on due to an overinflated housing market, which was fueled by an overwhelming load of mortgage-backed securities bundled with high-risk loans. That basically means the banks were making very risky investments and the people were buying very risky purchases, okay? Now, the mortgage-backed securities, that is, in short, an investment similar to a bond that is made up of a bundle of home loans the bank has issued. And they were bundling that with high-risk loans as well. So they're sandwiching it. And that is very risky. Because of that, the overinflated market formed a bubble. And like all bubbles, bubbles have to pop. So the market fell 20% on September 29th, 2008, causing the housing collapse. This US market collapse led to the broader world markets falling 10%, which leads to a global recession. The global markets are linked to the US markets because a lot of international governments invest in US bonds and the US stock market. So when our markets fall, their markets fall, leading to a recession, especially when it's this big of a drop. So I'm going to ask you a few questions. Now, what would have happened if people were a little bit more skeptical about a housing bubble? Would it have become that inflated, and would people have lost that much money? I personally like to think that if people were a little bit more skeptical, did a little bit more research into the housing market at the time, why it was that inflated, they would not have put their money into it. And they probably would not have lost that much money because they were making pretty risky purchases and banks were making pretty risky investments because people are still purchasing them. So I feel like if there was a little bit more skepticism all around, people would have been in a better financial situation right now. Because believe it or not, though it was 14 years ago, people are still recovering and have not recovered fully from the effects of their financial decisions at that time. And sadly, it's very easy to make a bad financial decision, but it's very hard to recover from it. So that is one thing that we should always remember. And this is the chart of that time. So here you can see September 29th, 2008, the peak and the precipitous drop into the early 2009s, or into the early 2009. And I want you to pay attention to how long it took for it to actually, for the market. This is the Dow Jones Industrial Average, which is basically a good representation of the entire US market. But I want you to see how long it took for it to come back to what it was before that drop. Almost 5 years for it to come back. So that is a long time. And you got to remember that means if you kept your money in to this index, let's say, then it took 5 years for your money to get back to where it was. And that is a long time. So we got to be careful when we're investing in the stock market. And something we probably all know a good amount about is the COVID-19 crash. And I put this as unplanned dangers because no one could really suspect that this was going to happen at the time. Yeah, the COVID-19 pandemic shut down global markets around in the entire global market, and the US market alone fell 20.3%. Majority of that happening in mid-March and a day known as Black Monday. Kind of scary. The US markets, global markets, and commodities all fell upwards of 5%. Commodities especially falling a lot more, with oil falling 22%. Which is why gas was so cheap during the pandemic, and it is not now, for sure, not now. But yeah, can't do anything about that. So, a few questions. Could you have planned for this? And would you have sold your positions? How do you handle unexpected risk like this? The thing about these types of risks, which a lot of economists call black swan events or tail risks, is because you cannot really suspect that these things are going to happen. You cannot suspect, for example, COVID-19 is going to cause a global wide pandemic, or that, for example, Russia is going to invade Ukraine tomorrow, if that was at that time. You can't suspect those things, and you can't suspect how it will affect the market. So planning your investments around that is difficult, and you will probably not succeed. So that is another risk that comes with the stock market. But I want you to keep in mind when you looking at this chart, compare this to the 2008 chart that I showed you earlier, how fast the market came roaring back from this really big drop. Okay. It took probably 6 months for it to get to pre-pandemic levels, or 9 months, I guess. Not 9 months for it to get to pre-pandemic levels. Before the end of 2020, we were back or above what we were before the pandemic. So that's because of many things. The Fed pumped a lot of money, but also if you pick the right stocks, like companies like Apple, Zoom, you made a lot of money during this time because they were doing very well during the pandemic. So just because there is a bad event like like COVID doesn't mean you can't find pockets and niches of growth within those markets. The next and last one is GameStop and AMC, and that we'll talk about recognizing fads, which is kind of what it was, kind of. It's a pretty complicated situation, but in short, GameStop and AMC was a volatile movement on the part of ordinary people, traders, that organized their buying to boost the price of these two companies, GameStop and AMC. This led to a lot of volatility in the market, as well as most hedge funds losing a lot of money because they had bet against these two companies actually losing price and losing their share price actually falling. So they bet that their share price would fall, but instead these traders boosted the price, which made them lose their investment. This volatility caused many trading platforms to shut down the trading of these two companies because they were scared. And this caused the share price of both those companies to plummet, causing ordinary people to lose a lot of money. So between January 19th and 27th, just a week, GameStop gained over 1,200% and AMC gained 651%. This is, like it says, without any change to the business model, no earnings report that really blew it out the water. There's no incredible change in these two companies that warranted such a fast and steep increase in share price. So people ask why? Well, it's because of this group of traders. And that is not what we call value investing. This is not based on the value of the company. It was based on the movement. And a lot of people were investing because of the movement, which is fair. But the problem with that is when they shut down the trading, GameStop stock alone fell 40% in 25 minutes. So in 25 minutes, people lost a lot of money, especially people that put a good amount of money into those two companies, GameStop alone. And AMC was similar to this. Now, what would you have done if you saw these two companies rising so high, so fast? Would you have invested, and how much would you have put in? Would it be worth the money that you could have lost? To those, I say personally, no, especially if you want to keep the money that you were putting into the market. If you like the money that you're putting in and you don't want to see it gone, I wouldn't say putting it into investment that is this risky. That being said, a lot of people did make a lot of money, and that's because they were able to pull out at the right time. The problem with pulling out at the right time or timing the market, it is very difficult to basically virtually impossible. Hedge funds put a lot of resources, a lot of money, and a lot of people towards timing the market, and they don't do it all the time. They don't figure it out all the time. So us as ordinary people trying to time the market with our normal computers and all that type of stuff is very difficult to, again, virtually impossible. and I'd lean to virtually impossible. So you do not want to put too much money on luck. That being said, a lot of these people that are investing in these two companies were doing it because of the movement. But if you want to keep your money, just be careful about how much risk you're putting the money into. This is the chart for these two, GameStop and AMC. That week, you can see how fast it went up and how fast it fell when they suspended the trading. And you can see if you invested towards the January 27th, 28th area, and you saw a lot of your money just go away really fast. Now, I shared a lot of really scary examples of the stock market, but I want you to remember that if you invest wisely and smartly, you can make a lot of money, and within good reason. So this is S&P 500, which is a group of 500 stocks that are kind of like quote unquote the best stocks in the market. Okay. So in any given day, you have a 52% chance the S&P will rise. In any given month, you have a 61% chance that the S&P will go up. And you have a 69% chance that in any given year, the S&P 500 will increase. So you're probably seeing a trend. And to really send that home, you have a 90% chance that in 6 years, the S&P 500 will have a positive return. And you have a 100% chance that in 16 years, the S&P 500 will have a positive return. So all of that to say, try to keep your money in the market if you have a good investment for as long as possible. The longer you keep it in, the more money you will likely make, and the higher chance you have of having a positive return on your investment when you are ready to pull your money out. So don't get scared when the market takes a tumble. And I like to say, don't look at the day-to-day of the market, because the day-to-day is always going to go up or down. Just like as you saw right here, 52% chance that it'll go up. So you don't rely on the day-to-day of the market. Rely that you pick the right company and stick with it. Okay. And I believe that's it. Yeah. So these are reflection questions. I hope you guys learned a lot about the risks of the market, as well as how to invest wisely in the market. And if you have any questions, you guys know who to contact. Know who to contact. Thank you so much for listening.